Hello, everyone. Thanks so much for joining us. Hopefully, the first day of the Montgomery Summit has been enjoyable, and a great time so far. We have some great programming ahead. And today, we're really going to unpack really the banking system and how we've migrated from simply unbundling the classic banking page where banks and fintechs are more in opposition to a model where we're more working together, collaborating, and fixing a lot of infrastructure that's quite outdated. And I have with me three amazing panelists. Andrew, my far left here, CEO of Extend. Peter, CEO of Synctera, and Rouzbeh, CRO of Orem. All are platform-based, really helping migrate, moving from legacy infrastructure and working with both banks and fintechs. And I think fintech has been particularly exciting the past 18 months to incredibly hot to, the public market is seeing a pretty major correction. So with that, I think, why don't we first start off by giving a quick background on yourselves and what your companies are doing at a high level. And I'd love to set the stage a little bit more on kind of where we are in terms of infrastructure. So just quick intros first.
Yeah, so Extend is a platform that is really enabling the traditional banks with some of the digital tools and assets, APIs, user experiences that they've been lacking. And they've been shown how to do it by fintechs. So we've taken a bit of a contrarian view, is to actually go and help the traditional banks on that journey of innovation.
Cool. I'm Peter Hazlehurst, CEO of Synctera. And my background, long-time fintech person, came to the US in '93, built the first core banking system on Windows. And that platform still runs. It's kind of scary. It's 30 years old. And half the team still works there, which is proof that banking stuff never dies. But anyway, so Synctera sits in the middle and is a marketplace between fintechs on one side, for which there's effectively still infinite demand of people launching neobanks for pretty much everything. And on the other side is a marketplace of community banks, ranging from as small as Lineage, which is a brand new de novo bank, started a couple of years ago, to as big as Veritex and some others that we've been working with that are sort of 12 to 15 billion in assets. And our job is to matchmake the use case of the fintech to the right bank, which wants to take the right amount of risk. If you want to do cannabis banking, we have a bank in Oklahoma that will do that. You want to do crypto, we have BankProv that will do crypto-based fintechs. You name it. Our job is sit in the middle, manage the arbitrage or the price equilibrium. So there's a lot of fintech demand. There's not enough supply from the bank, and helping find that right partnership over time.
Thanks. Rouzbeh Rotabi. I am the Chief Revenue Officer at Orem. Been in fintech for about 2 decades, so I got into it when knuckle busters were still a thing. I don't know if anyone saw Stripe's ad on April Fool's that had the old credit card imprint machine and said it's our newest technology. So the gray hair will tell you that it's been around for a while, and the revolution's good to see. At Orem, the interesting problem that we're solving is the last horizon, the last piece of the triangle of money movement being modernized. Issuing was modernized in the 90s and 2000, or acquiring was modernized in the 90s and 2000s. First data came with a wave. Then in 2010, you saw Stripe, you saw Adyen. After that, you saw issuing be modernized by Marqeta, Lithic, I2C, Highnote, go down the list. But in today's day and age, we still rely on ACH. It's a 50-year-old piece of technology. I don't know who's driving a 1972 Bug. That was the #1 car 50 years ago. The #1 consumer electronic was a home recorder that was the size of an oven. And so why have we not done anything to attack that last problem? And it's really to help modernize that, because trillions and trillions of dollars still move through that. To be specific, 49 trillion in B2B and roughly 27 in consumer. So as you think about how to modernize that from an enablement standpoint, fintechs, banks, and B2B platforms will need a service and solution for that. And thanks for having us.
Yeah, we also have fun socks. I don't know, I haven't seen your socks here. Okay, never mind. I think that teases up really well to kind of highlight fintech. Last year saw 134 billion in VC investment, and as three panelists who have really spent a lot of time in the industry, what do you think makes this a particularly exciting time in terms of infrastructure, in terms of where we're going?
So maybe I can take the lead here in some ways, or answer first. So what we're seeing is the proliferation of community groups wanting to organize themselves around banking or fintech or some sort of use case. And the sort of analogy is very, very similar to Shopify's sort of instigation, which was stepping up a web portal, web shopping site was actually quite hard prior to Shopify. And they basically said, look, we'll do everything you need. We'll get you up and running. We'll give you the basic services. And what happened was millions of new types of websites got started selling as simple as, secondhand shoes or whatever. They didn't judge whatever you wanted to launch. The same thing's happening in banking now. And it's a bit of a resurgence of what happened in the 50s and 60s with credit unions, where communities are organizing, whether they're LGBTQ or different sorts of sporting groups and whatever. And if you can make it really easy for them to get access to their banking and payments, they're starting to really grow really quickly. And so if you are the infrastructure player helping those people build those infrastructures or those platforms, there's just tons of demand right now.
So I tend to think that what's happening in financial services is what actually happened in the enterprise resource planning space between 95 and 2005. So wind the clock back to 94, which is when I started my career, and I worked alongside SAP, and I'm dealing with green screens and mainframes. We're still dealing with green screens and mainframes in banking today, right? So you look at how the system evolved there in enterprise resource planning, and SAP was a pretty good model. They recognized that they were the ledger of choice, and no one was going to change the ledger once it was there. No reason to, right? It's like an abacus. It ain't changing. Debits and credits. The reality is they realized they couldn't be all things to all people. And so what they did is went and really created the first set of APIs that allowed for software technology providers to build over the top of them, and then they went and bought the best of them. And I think the same is actually happening now. You look at what's happening with FIS and Fiserv and TSYS, right? There's been a lot of change happening, but really what's happening is between them, the strategic providers to the banks, and also what's happening at the banks themselves with competition, they're being forced now to open up their ecosystems. And that is what is allowing now the proliferation of new solutions to come into play. And so I think we're going to see that steady stream that's just going to continue.
All great points, especially the green screens. That resonates. I'd also add that fintech's revolution is to what SaaS was to ERPs. If you think about it, ERP was the only way to run your business. You had to buy some big piece of software, client-server model, hours and hours of implementation. But SaaS companies came up with things as big as Salesforce that replaced many, many services, Siebel, Goldmine, Act, et cetera. So valid points. I think the other aspect of it is think about experience. Consumers today and businesses today are really looking for more advanced ways to interact with moving money, whether that's through a card, through a rail, or to pay a bill. And if you hit those two vectors of how is a consumer opening up a crypto.com app and opening an account, how can they instantly move money into that account? Well, you can move it through a card rail, great product, absolute perfection from an experience standpoint. I don't mean this in a bad way. We're all trained humans that we know our card numbers. You could punch it in right away, load the funds. But what if you want to get that unit economic improved? What if you want to figure out how to get more clarity and link your bank account and have all your financial services in one ecosystem? Plaid's had a lot of success with that. Kudos to them. But I think it's a matter of that experience, bringing that to that level of how do I make this seamless and streamlined. The second piece from a B2B standpoint, the job of the CFO has become much more complicated. There's FP&A, there's ledger management, there's balance sheet, there's everything else. Paying bills used to be just kind of a pain in the you-know-what. It's a matter of how you can automate that. How can you automate all my invoices? How can you automate all my money movement from one side to the other? So all those trillions of dollars going from, say, Oracle or SAP to all their vendors? Or in the opposite manner, how do I get human time out of that? And how do I have the machinery replace all of that with software? So I think that's where you're going to see the proliferation of both consumer side and the B2B side.
I think those are all excellent points, especially as I like to describe it as kind of bridging that chasm. I think there are some things that you have to integrate with in terms of our current banking system, especially to empower new businesses and fintechs to really accelerate and create the next wave of innovation. I think it'd be really helpful for the audience to give us a little more insight in terms of the technology you built. Maybe, Andrew, if you could start in terms of, how you've kind of structured Extend and maybe give an example of how a consumer or business would use it.
Yeah, so we've taken a bit of a contrarian approach, right? It's not about burning down Rome. It's about mixing the old parts of Rome with the modern parts of Rome. And so that's really been our philosophy is you don't have to start everything from scratch. The reality is you just need to reinvent things. And for that to happen, you need to go outside of the traditional banking ecosystem, which is why fintech is extremely powerful. And the reason why it's powerful is we get to attract talent. We also don't get hung up on compliance, right, when the business is barely off the ground, right? We right-size the type of compliance oversight that we put there. And I think the other thing is our funding cycles work much, much more effectively than that of traditional banks. A traditional funding cycle is 18 months. And then you're lucky if a year later you get the same degree of funding because the president changed, the direction changed, and you're back to square one. I think the big, big difference here is fintechs are made and built to fail fast. And so really what we were doing was saying, okay, let's take all these individual services from these banks, let's reorchestrate them, let's take a leaf out of Marqeta's books, and then allow banks to offer modern APIs sitting on their older infrastructure. Allow then people to embed payments. Importantly, allow people to embed not just the payment of a given bank, but of any given bank that that corporate customer is using. So start to be present where the customer is. Don't reinvent an experience. And how do you mesh all of that together? So take the example of what we've done with American Express. In today's world, we have a lot of contractors, freelancers. And the reality is you want to empower people with a card, whether it's to pay for online subscriptions or whether it's to go travel. They don't need to become a card holder at the bank. They don't need to go through that whole onboarding process, right? And so the reality is, how do you allow, therefore, an existing card holder from the very card they have in their wallet to be able to register that account and now shard it into as many pieces as they want? Just by having someone's email address, I can empower you with a card in 5 minutes. From the card I already have, no change in relationship. I'm not selling you a new product. I'm selling you just new digital capabilities off your existing platform. That's instant access to 15 million cardholders, right? And now you start replicating across other banks. You start saying, well, I can now access as many people as there are physical cards in circulation. So that's what we're talking about, removing friction from the system and enabling people now to use the fact that we can use contactless at the point of sale. Because COVID helped with one thing, which is help with contactless, and now get to the whole idea that digital cards can replace physical plastic in so many situations. So that's the instantaneous nature of what we're trying to solve for.
Peter,
So
I think you have an excellent example with Pet Bank, probably.
Yeah, so I guess we are very contrarian in tech stacks. So here are mainframes. They should go and die, but they never will. And here is modern fintech infra. So in our case, what we've done is deliberately chosen not to connect in any way, shape, or form to whatever the bank is doing for two reasons. One is because there's an incredible cost of integration and testing and verification and certification. And the second thing is you lose all the flexibility. So you end up being constrained by whatever the bank can do in their core at some point. So what we've done, which is a little bit different, is we've built effectively a mini core banking system, a ledger, that allows us to fundamentally understand what's happening in a bank account on behalf of a consumer. On top of that, we have then integrated and built all the other services that you need to onboard a new consumer, whether it's doing KYC or doing ACH money movement, doing push to card, and so forth. And the goal for that is to make it possible so that a founder who knows something about an industry but doesn't know anything about banking can get to market really quickly. The best example of that is Robert, who's the CEO of a company called Synctera. And these guys are building a neobank for people that love pets. And it's fantastic. It's really, really great. And he's an expert in the pet food industry, but knows nothing about banking. So we've abstracted away all the complexity of compliance and all of those sort of things. We make sure the program's safe and sound, and then we match him to a bank that's going to manage his risk appropriately. And we did that with nobody having to change anything in their core systems. We didn't talk to the bank's infrastructure. I remember meeting the Fiserv team, or the FIS team, and they're like, well, we're going to start a program manager, and we're going to set up a project to work with you. And I'm like, no. And he's like, well, what do we need to do? And I said, I need a location where we drop off a file. And he's like, that's it? I'm like, yep, that's it. And the upside for that is fast time to market. You can onboard lots of banks, and you can get different use cases and situations solved depending on what the fintech wants to do.
Feel free to add on the Orem side if you'd like, but maybe touch on, as you're building with banks and fintechs, what's kind of most important to each side if you had to condense into 2 or 3 points?
Yeah, I think the biggest thing with the fintechs is, as Peter mentioned and Andrew mentioned, is enablement. So if you think about it, you want to move money, but you don't know how. You're brand new to the fintech space. Okay, well, you need to call someone that has understanding of ACH, RTP, and soon to be Fed now. So you have to have the knowledge and the acumen, but you have to make it consumable for the end customer or the end prospect in that state. I think the banks are going to get a win from all the fintechs because at the end of the day, they're the access point to all the financial infrastructure. So whether you're a program manager and you issue cards, you still need an issuing bank. That could be Sutton, that could be Stride, that could be the newest one, Column, that was stood up. If you're moving money across ACH rails, you still need someone to connect you to that rail. You still need someone to work with that. So on one side, you're taking goods and services from the bank, you're packaging a better experience around that, and then you're offering that to a variety of folks. So I think that if the banks take a step back, they can look at the entire fintech landscape and say, how can we go attack more TAM through, if you will, a channel partnership, through strategic partnerships. From the fintech and from the money movement standpoint, I think the biggest key is how are we improving the experience? How are we improving the overall ecosystem? The best thing about it is removing the logistics on the back end. When you buy something from Amazon, if that product's moving via UPS, FedEx, or all that, you don't care. You either ordered it next day, 2 days, or 5 days from now. It just depends on what the end experience is. Cards are instant, ACH is T-6, and you have to think about that from a consumer standpoint. So the banks can get a massive win out of this, and I don't think there's a rivalry anymore. I think it's more frenemies or co-opetition.
I think you brought up a really excellent point on kind of how distribution is changing. And I think, Peter, maybe you can describe this on the sponsor bank side. 5 years ago, I think, if all of a sudden, only a handful of banks were really involved. Kind of how have you seen that emerge, and how is Synctera really opening up kind of distribution channels here?
Yeah, no, I think that's really interesting. For us, when we got into this business, the key problem for fintech execution was a lack of supply. So if you think of it as a marketplace where the fintechs is demand, the banks are supply, there just weren't enough banks doing it. In round numbers, when we started 2 years ago, there were about 30-ish banks that semi-professionally did sponsor banking. Out of that, 10 really did it with actual profitability and so forth, and the other 15 to 20 were sort of figuring it out and learning. And what that meant was that if you were a fintech and you were trying to get started, the sponsor banks were just cherry-picking the best deals. And they're saying, I'll do a deal with Uber, but I won't do a deal with Synctera. And the downside for that would be if you're a fintech and you're getting started, you need to raise $2, $5, $10 million just to have enough cash in the bank for the bank to even talk to you. What we've done by bringing on 11 new fintech banks in the last 12 months is really open up more supply. And with more supply gets more preference and more opportunity. And the supply is variable, right? So if you want to do something with cannabis, you need a specific bank that's going to be comfortable doing that. If you want to do lending, some banks will do lending, some banks will do deposits. And our job is to expand supply, which allows the fintech to have more certainty that with lower amounts of money raised, they can go to market. And the end state of that is what we've launched called T-10, which is self-discovery. Go launch your own neobank, we don't care. And you can go up to 50 users with no constraints. And then when you're ready, find a match to a bank. And what that means is so much more innovation. So I think we're all sort of thinking, is the TAM of fintech really understood right now? I don't think so. I think we're very much like e-commerce TAM prior to Stripe. Prior to Stripe, if you were lucky, Braintree or Adyen would return your phone call. And you had to be Ford or Nike or someone. Stripe came along and suddenly 1 million websites, 10 million websites had e-commerce. Shopify did the same thing for purchasing and consumer. And that's what's about to happen in banking as well.
And then, Andrew, you brought up a great point in terms of working with issuing banks and essentially extending to 15 million or so cardholders. As you see this area of kind of infrastructure and platforms developing, can you kind of touch on how we're really moving from kind of one-to-one connections to many, where there's just a lot of interaction across fintechs and banks, and it's not like I just have one relationship?
Yeah, I think a lot of people fail to recognize that fundamentally, you don't change your bank very often. Right? I hazard a guess that most of you haven't changed banks in the last 10 years. Right? And if you think it's difficult for a consumer, it's even harder for a business. Right? And yes, fintechs are different, but there's mostly traditional businesses out there. And so that was our first recognition was, yes, I need digital tools to be able to go and power our platforms and integrate payments What I don't necessarily need is every time to change banks. What I need is the digital tools. I need the modern stack of APIs. I need modern user experience that are adapted to different industries, to different verticals. And that's been our view, is I'd rather service 95% of the existing market than try and build a market from scratch. And so, you take the example of Amex, but we're increasingly going out with 7 other banks that we've now partnered with. It's about being able to touch every one of their existing customers, right? And be able to take away that friction of saying, it's happening with the card you have, it's happening in minutes. And it's really about a new distribution model that says, in the old days, you'd have to go and set up every user. No, it's a peer-to-peer model. So all I really need is your email address. And if I have your email address, I can give you a card in 30 seconds. And so that's where we start to think about what that distribution looks like, because now every cardholder becomes its own distribution network, because it's about them being able to enable individuals underneath them without having to do actual issuance of new cards and KYC and OFAC and all the different things. So it's really about expanding that and giving the flexibility to those users and making it simple. That's the key.
And I think that's at March, when we look at investments and look at our portfolio and roadmaps, the idea of removing friction is always incredibly important. And obviously working with banks and fintechs, they operate at different speeds, is how I'll phrase it. So what do you think is crucial for a successful partnership between kind of your relationships with banks?
So number one, you have to be relevant. I think what is, as a startup, what is relevant to you and what is big is really meaningless to a lot of these big established banks, right? They're talking, and I was reminded of this when I used to work at Amex. I'd grown a business from essentially 0 to $10 billion, and I was extremely proud, fastest growing B2B platform. And I walked into the head of the strategy at Amex, and he said, that's great, but we're a $1 trillion business. I'm like, thank you for dampening my spirits. Because for a fintech, 10 billion in volume would have been really quite sizable. So the one thing you have to also step back is saying, are you relevant? I then think is, can you truly deploy your technology inside of the ecosystem in such a way that you're not asking them to stand up a tech project? Because if you are, you're 3 years in the making already there. Forget the next stage, which is like, okay, we love your technology, we think it's plug and play, now we need to onboard you as a vendor. Well, that's another 2 years worth of effort. So you also need to rethink what it's like to interact with these bank partners. And so we changed the model by going to their strategic partners, right? Going to MasterCard, going to TSYS, and effectively becoming a vendor of theirs. And so enabling them very seamlessly to issue a statement of work that allows them to work with us, right? In a matter of weeks, not months, not years. And so I think you have to rethink the model, because I think the old school is like they're impossible to work with. Actually, if you understand the ecosystem, right, and you understand what the end game looks like, then you realize that actually you get access just to a huge, huge number of customers in a very seamless fashion. And that's the end game, right? But it's not for everybody. Some people want to be net new disruptors every time. We just, as I said, took a slightly contrarian view that actually we think we can service customers better, right, through the traditional banks.
If either of you care to add on that.
I think one thing about the banks is, if you think about it as a conduit, because the end customer, or the end consumer, or the end B2B customer, I don't think they're really that entrenched in who their bank is. They're trying to understand, can it weld around what I'm trying to build? Mm-hmm. Can it move at the speed that I need to move? And is their technology modern enough from taking ISO messaging into API messaging? And how do I extract data and pass it down to my customers? So if you think about creating a layer, an abstraction layer where a platform sits in between 20, 30, 40 banks. In your case, you said there's 10. It's a matter of finding the right banks that can be that conduit. And every bank has a different risk tolerance. And that's what you have to optimize for. Whether you get into cannabis or you get into crypto or you get into Web3, you have to understand how to play that matchmaker, but you have to leave it transparent on the other side. You can't bring them into that clunky experience of selecting the bank.
I think that's an excellent point on, obviously, risk and compliance is crucial to a bank. Peter, you're obviously a marketplace and a matchmaker. How do you think about creating that level of transparency on the platform?
So I think there's a couple of layers to this. One is you got to start with the tech stack. So are you starting from the beginning with compliance in mind and saying, yes, in fact, we want to KYC every user and we want to run programs that are legal and compliant in the US? The second part is recognizing that for the most part, the fintechs we work with are unaware of what the compliance goals are. And so you have to find a way to either teach them what to do. It's as simple as saying you actually have to watch a rules set of videos minimally in order to launch a program. So you have to get the CEO and say, please watch this video that talks about UDAP. And you guys probably don't even want to know what UDAP is, but it's unfair and deceptive advertising practices. And every literal CEO of every fintech must watch that video. And why? Because it's by second nature, the goal is to grow. And you might just sort of tweak and bend the rules a little bit and say, what if I tell the consumer they're going to earn 25% interest on this checking account? Well, you can't earn 25%. It's not possible. Otherwise, you'd be a stable coin that's not very stable. Ooh, too soon. And but anyway, so
I have a question
that sort of managing of expectations of what you're allowed to do. And then the irony is many of our community banks that we work with have created great franchises in their local towns and communities. But when approached with the growth potential of what happens in fintech, all the work they would do doesn't scale. So imagine a community bank that's being really successful, growing at 200 commercial accounts a week, which for a community bank, that's a great business. And they come along and have a fintech powered by us that's growing at 25,000 accounts a week. So all the process, all the thinking about how am I going to review everybody's social security number, you know, the branch would say, please come on down and show us your driver's license. You can't do that online, but you have to do it. And so putting tech in place to manage by exception the craziness of compliance is in fact what works. And then educating everyone on what the minimum requirements are is probably the most important thing.
If I could add one thing, I think the fintechs are also bending the compliance rules. Give you an example. Years ago when Apple Pay Cash and Cash App launched, they were one of the first experiences where they forced the use of the last four in your social security because they knew people wouldn't put in the full 9. So you put in the last 4, it hits Alexis, or back in the day, SoCare wasn't around, and it returns the full 9. At Marqeta, we went at great lengths. At Green Dot, we went at great lengths to get this through. So I think leaning on the fintechs, having them prove the question of like, that law was written 40 years ago when everything was blue screens, green screens, and everything else. So I think we have to lean on the fintech community to change the compliance rules within reason.
And I think it has happened, by the way, with PSD2 and open banking. They've basically broken what was a monopoly, right? And that has forced banks to open up their APIs. And by definition, it's forced them to get down the innovation path. And you think of the budget that banks have, 80% of it goes towards compliance. They have no capacity for actual innovation, you know. And then you overthrow the funding cycles, which take 18 months. They're just not built for it. So fintech is the right answer to help them get out of this.
And Rouzbeh, you could, I think, because data is so crucial to Orem, can you talk about how, you know, even 3-5 years ago, the amount of data that was available and using machine learning AI wasn't really there to really solve a lot of these kind of core problems around risk?
Yeah, if you think about, I'll use the credit business as an example. Credit modeling and credit risk, you know, vintages, if you were, you'd build a scoring model. You'd say if your credit's above 650, if you made this much money, and then you'd authorize them yes or no. If you look at what's happened with all the nouveau credit systems and all the new implementation of that, you're actually improving those vintages day by day, week by week. More data through the system lets you see more information, and you're like, okay, hold on. This person had a 650, but they're 25 years old. This person had a 650, but they're 47 years old. Different lineage, different experiences. Someone might just be new to credit, and someone might have unfortunately damaged their credit. And so if you apply that from a payment standpoint, whether it's authorization or risk approvals on transactions, in our case, we're trying to understand, you know, between 20 and 30 fields every time we see an ACH go. When was it sent? What time of day? How much was the amount? What's the institution? What's the institution it's landing at? And the more you can amalgamate and put together, you're going to get smarter. And I think it's one of those things that's like human beings. We're born unfinished products and we'll die unfinished products, but we have to continuously improve.
That's a great way to put it. We're approaching time here, but I mean, we covered so much, and it's such a complicated field. If you could leave the audience with, you know, a 30-second to take away on what they really should be thinking about, what would that be if we just go down?
Yeah.
Depends on what side you're on, but on the investment side, I think about the size of the problem that people are attacking and the consumer experience or the business experience, because that's the triangle. How big is it? What are you improving, and how often can you, what's the ability for people to understand? Are you selling ice cubes to people that want ice? Or are you trying to attack a problem that no one really understands?
So my take on it is, having sort of lived through 2008 and 2001 and various corrections and other things, that in this period of transition is where you get the coolest companies and the most crazy innovation coming out. And I'm super duper bullish on new stuff coming to market right now. We're seeing effectively infinite demand on our inbound stack. We're seeing 10, 15, 20 fintechs a day saying, hey, can we use your platform? And not all of them make sense. And there's probably 3 or 4 people trying to invent the card that allows you to swipe other people's cards, all of which we tried to do several times at Google and didn't sort of work out very well. You may have heard of Google Wallet. But it's cool to see all this crazy ideas coming to market. And because the cost and the effort required to launch something is so much lower than it was 5 years ago, lots more ideas are going to get tested and tried. And some work and some won't, and that's okay.
I think the key takeaway for me is you don't have to reinvent everything from scratch. I think, and it's not even just about the banks, by the way. I think inherently everyone's going to get more comfortable with the idea that experiences will be delivered through the software tools that people are already using, right? So the model, the easy one, everyone says, well, Uber, you don't even know you paid, you get out of the car. That's the consumer world. I think in the commercial world, it's going to be very much the same, and what people need to be looking out for is how are people going to go and embed things into a Concur experience, into a Cooper purchasing experience, and then how are people going to start creating a standard? Because by the way, standards exist on the merchant side of the world. Standards exist for ACH. There's no issuing standard in the world today. So there is going to have to be some issuing standard created. And I think that's going to be really interesting as to how people think about how you create that issuing standard. So again, I think fintech, right place, right time. I think this downturn is a perfect timing in terms of refocusing people on really core problems.
Wonderful. I think that's excellent. Thank you so much for being here today with us. We'll be here, and then after this, we'll have a reception at the Getty. But thank you. Let's give them a round of applause.
Thank you.